5. Insurance to protect businesses. Many of the disability and accident and sickness (ANS) insurance plans dealt with in earlier chapters of this manual relate to income protection and health benefits of individuals, whether owners or employees of businesses, or the self-employed. There is also a whole field of disability insurance (DI), designed to protect the businesses themselves in the event of the disability either of an owner or of an employee who is critical to the success of the business. These plans include Black Small Square Disability Business Overhead Expense (BOE) Insurance, Black Small Square Business Loan Protection, Black Small Square Disability Buyout Coverage, Black Small Square Key Person Coverage. Before looking in detail at how these plans work and the benefits they provide, it is important to understand the different types of business structures and the various risks faced by business owners. Additionally, this chapter will touch on some of the less common insurance benefits offered by businesses to their owners and employees, such as health and welfare trusts, HWT, and health spending plans. 5.1 Forms of business ownership. The type of business structure an individual or group of individuals chooses for business operation can impact a wide variety of issues, including the simplicity of operating the business, the administrative costs of operating the business, the tax rate at which business profits are taxed, and the degree to which the business owner is personally exposed to the liabilities, including creditors, of the business. The following types of business structures and some of their advantages and disadvantages are described in detail in this section. Black Small Square Sole Proprietorships, Black Small Square Partnerships, Black Small Square Corporations. 5.1.1 Sole Proprietorship. A sole proprietor is the only owner of an unincorporated business. It is operated by its owner, who personally receives all the benefits. Sole proprietorships encompass a wide variety of business enterprises, including self-employed individuals, consultants, tradespeople, artists, and so on. In fact, by far the majority of businesses operating in Canada are sole proprietorships. The main attraction of a sole proprietorship is that it is inexpensive and easy to set up and operate. Some provinces require that a sole proprietorship business be registered with the province for a relatively modest fee. The primary downside to operating a sole proprietorship is that the business financial affairs of the proprietorship and the personal financial affairs of the sole proprietor are inseparable. The net income of the proprietorship is income of the proprietor, to be reported on his personal income tax return. There is no opportunity for the business income to be taxed at a separate, lower rate as there is with an incorporated business. And the personal assets of the sole proprietor are exposed to the business creditors of the proprietorship. 5.1.2 Partnership. A partnership involves two or more individuals carrying on a business together with a view to making a profit. The partners share in the net profits or losses of the business. Partnerships are more complex than proprietorships. Revenues and expenses are computed at the partnership level, and net income is reported to the individual partners, pro rata, according to the terms of a partnership agreement. Income tax is not computed at the partnership level, but the net income is reported to the partners and taxed at each partner's personal tax rate. The prime disadvantage to the partnership structure is that partners may be jointly liable for debts and liabilities of the partnership. For example, a lawsuit filed against the ABC partnership as a consequence of the negligence of partner A could also be the responsibility of partners B and C, even though they had no role in creating the liability. 5.1.3 Corporation. A corporation is a separate legal and tax entity, separate from its owners, the shareholders. The corporation itself carries on business through the efforts of its owner/operator, and employees. Ownership of the corporation is in the form of shares, which represent a pro rata interest in the net value of the corporation. For example, someone who owns 5% of the outstanding common shares of a corporation owns 5% of its net value. Control of the corporation is effected through share voting rights. One common share gives one vote. Corporations may be small, closely held businesses, with as few as one shareholder, or large, multinational operations, with perhaps hundreds of thousands of shareholders. Corporations are legal entities separate from their shareholders, such that the liabilities of the corporation do not become the liabilities of their shareholders. Corporations are taxed on their net income, often distributing their after-tax income to shareholders in the form of dividends, which are taxed in the hands of the business owner at substantially lower rates than salary or interest. Corporations are divided into two general categories, private and public. 5.1.3.1 Privately held. Privately held corporations do not offer their shares for purchase to the general public. The shares are owned by a limited number of shareholders, sometimes only one, who are typically owners/operators of the business. A private or closely held corporation is generally established to operate a business either for tax advantages and/or protection for owners from the creditors of the business. In Canada, the net income of a private operating company is taxed at a low rate. If a shareholder, who may be in a 45% marginal tax bracket, does not require current access to all of the net income generated by the business, the corporation can be an effective tool for deferring tax on the profits of the company. 5.1.3.2 Publicly held. Public corporations, like Bell Canada, often have tens, or hundreds, of thousands of shareholders, and their shares are usually traded freely on a public stock exchange. Their shareholders are not owners/operators, but merely investors, who hold the shares for their income, dividends, or growth, capital gains, potential. As such, the shareholders are not exposed to the liabilities of the corporation. 5.2 Risks to the business owner. In the operation of a business, business owners must often deal with risks related to disability. Black small square risk of being unable to work due to disability. Black small square risk of being unable to sell the business, a need triggered by disability. Black small square loss of a key employee to disability. All three of these risks need to be examined in some detail, and all can be mitigated through specific forms of disability insurance. 5.2.1 Inability to work. Whether a sole proprietor, a partner, or the owner or co-owner of an incorporated business, the business owner's ability to earn an income and meet obligations to creditors, suppliers, the bank, the Canada Revenue Agency, etc., rests primarily on his ability to work and generate revenue. That ability can be compromised, sometimes permanently, due to disability arising from accident or illness. A 45-year-old male, a fairly typical age for a business owner, has about a 40% chance of suffering a disability lasting longer than 90 days prior to age 65. And the average duration of such a disability is 3.2 years. In the case of two partners or co-shareholders, both age 45, owning and operating a business, the likelihood that at least one of them will experience a disability lasting 90 days or longer prior to age 65 rises to 62.5%. 27 These risks become slightly more pronounced for younger individuals and slightly less pronounced for older ones. Statistics such as these 28 illustrate the significant risk to which business owners are exposed. Risk could imperil their financial security and their retirement plans. 5.2.2 Inability to sell the business. A business owner's business interest is usually his most significant asset, greater than a home, registered retirement savings plan, RRSP, investment portfolio, pension, or any other asset. The business is the owner's source of current income, the primary retirement asset, and in a worst-case scenario, emergency fund. But the business can only fulfill these roles if it can be sold at the discretion of the owner, within a reasonable time frame, and for a fair price. 5.2.2.1 In the event of disability. A business owner who becomes disabled may be forced to sell the business in order to maintain a reasonable standard of living. Where the onset of disability is sudden, leaving little or no time for advanced planning, a number of obstacles to a successful sale may arise. For example, black small square How to identify a potential buyer. Black small square How to convince such a buyer to commit to acquiring the business. Black small square How to negotiate a fair price, particularly if the seller is negotiating from a position of weakness, the need to sell. Black small square how to ensure that the buyer has sufficient resources to execute the sale, and to do so in a timely fashion. Every day that the sale is delayed while these obstacles are being overcome, if they can be overcome, the likelihood of achieving a sale at a fair price diminishes. And the business owner's interest isn't the only thing at risk due to his disability. Employees of the business will be concerned about the security of their jobs in the absence of the owner. And co-owners may be burdened with sharing business profits with a non-productive disabled co-owner, or concerned about having to work with the spouse or other family members of the disabled owner. 5.2.3 Loss of a key employee. A key employee is one who contributes materially to the success of the business and whose skills and services would be difficult to replace. The business may rely substantially or fully on the services of the key employee. If the employee should leave the business, quit, retire, die, or leave for any other purpose, particularly if the parting is sudden, the financial survival of the business, and by extension of the business owner, could be at risk. 5.2.3.1 In the event of prolonged disability. The disability of the business owner or a co-owner is not the only disability risk. The loss of the services of a key employee to disability could equally cripple the business. This loss might make it impossible for the business to function effectively if the disability is total and lasts for several months or longer. Fortunately, the impact of these risks can be reduced or eliminated with proper insurance planning. 5.3 Insurance to address owner's inability to work. If a sole proprietor operating a consulting business with no employees becomes disabled and unable to work, the proprietor's income can be replaced using individual disability income replacement insurance. In the case of a disabled business owner who operates a small manufacturing business or similar enterprise involving business premises, equipment, and employees, the solution to maintaining the business during a period of disability becomes far more complex. 5.3.1 Disability Business Overhead Expense, BOE, Insurance. Disability BOE insurance is available to qualifying businesses and business owners, and is designed specifically to pay specified ongoing business expenses while the business owner is disabled and unable to generate revenue for the business. 5.3.1.1 Purpose of the coverage. While many business owners have insured their net income against possible loss due to disability, the revenue stream of the business and accompanying expenses are often overlooked. BOE insurance is designed to help business owners meet operating expenses and keep the business and business assets viable, so that the disabled business owner will have a business to return to upon recovery. 5.3.1.2 Who needs/qualifies for business overhead expense, BOE insurance. BOE insurance is specifically designed to meet the needs of the small business owner. Sole proprietorships and partnerships or closely held corporations with 5 employees or fewer may qualify. The thinking is that the services of the owner of the business are so vital to its profitability and success that an interruption of revenues due to disability could cripple or kill the business. However, if there is a co-owner or employee whose services could replace those of a disabled owner, then the business might only qualify for a lesser amount of coverage, or be disqualified entirely. 5.3.1.3 Definition of disability. The definition of total disability for these policies is some form of regular occupation. See Chapter 2 for a definition of regular occupation. If the business owner is unable to perform his regular duties with the business, the definition has been met. An owner who cannot perform regular duties will trigger a decline in business revenues and a likely inability for the business to meet its ongoing obligations. Any definition of disability that would allow for the insured to perform the duties of some other occupation would be inappropriate, since that would not help the business to survive. 5.3.1. For what expenses qualify for reimbursement? BOE policies are designed to reimburse the business for regular, ongoing business expenses incurred while the owner is disabled. Here are a few. Black small square rent of the business premises, black small square property taxes on owned business premises, black small square business income taxes, black small square utilities, heat, water, natural gas, electricity, black small square vehicle leases, black small square salaries of most employees, black small square phone, internet and other communications charges, black small square loan interest, black small square lawyers and accountants fees. There are, however, a number of expenses that would not be covered, including black small square capital portion of loan payments, black small square new capital expenditures, black small square salary of the disabled owner, black small square salary of someone hired to temporarily replace the services of the disabled owner, black small square salaries of employees who are able to independently continue to generate revenue for the business, black small square salaries of relatives of the disabled owner who were brought into the business after the onset of the disability. 5.3.1.5 Benefits. BOE policy benefits are normally payable, monthly, on a reimbursement basis. Details of the amount and administrative procedure for the payment of benefits are outlined below, under benefit maximums and carryover of benefits/expenses. 5.3.1.6 Waiting period. BOE policies typically have a fairly short waiting period before benefits begin, sometimes as short as 15 days and seldom longer than 90 days. This is in recognition of the fact that, in light of the total disability of an owner, the business might quickly fall behind in its financial obligations. 5.3.1.7 Benefit maximums. At first glance, the benefit amounts and benefit periods associated with a BOE policy seem the same as for personal disability income replacement policies. For example, a BOE policy might provide $6,000 a month for 24 months. But the $6,000 a month is a maximum monthly reimbursement benefit, not really a fixed benefit, as with an income replacement policy. The full $6,000 is only payable in a given month if at least $6,000 of qualifying expenses is claimed. Policy benefits remain in force until the earliest of the following events: the business owner recovers and returns to work, the benefit maximum has been claimed, or the business has been sold or terminated. 5.3.1.8 Carryover of benefits/expenses. The more flexible contracts permit a carry forward of unused monthly benefit maximums and or unclaimed expenses to be used in subsequent months. This is in recognition of the fact that many business expenses are not spread evenly over the course of the year. Some, like business premises rent, internet charges, vehicle leases, and other expenses, may be equal each month and predictable in advance. Other expenses, like heating, lawyers and accounting fees, and fuel costs, may be seasonal or only sporadic throughout the year. In recognition of this, it makes sense to have a reimbursement schedule that can handle monthly disparities. Flexible contracts permit two types of carry forward. Expenses in excess of the available benefit maximum in 1 month can be carried forward and claimed in future months, should claimable expenses in those months be less than the benefit maximum. 5.3.1.9 Provisions/exclusions. In addition to base benefits, BOE policies may offer a variety of standard or optional provisions, including black small square waiver of premium, black small square return of premium, black small square future purchase option, FPO, black small square a presumptive disability clause, black small square a partial disability clause, black small square residual disability benefits. Benefits. BOE policies are normally owned by, paid for by, and payable to the business owner or, in the case of partnerships or incorporated companies, to the business itself. So long as the policy only covers qualifying expenses, the premiums are a tax-deductible business expense for the payer. On the other hand, any benefits paid to the policyholder, or on the policyholder's behalf, are treated as taxable income. This is an exception to the rule, where benefits payable under business life and disability policies are normally paid tax-free to the business. However, since the expenses covered by the BOE policy are normally themselves tax-deductible as business overhead, the tax on the benefits and the deductions for the expenses generally offset each other for tax purposes. 5.3.2 Business Loan Protection Disability Insurance. Separate from BOE insurance, businesses and business owners can purchase disability insurance intended solely to make business loan payments during a period of disability. 5.3.2.1 Purpose. As explained under Disability Business Overhead Expense, BOE insurance, one of the many types of expenses covered under such policies is periodic interest payments required under a business loan. Loan protection can also be provided under standalone contracts, called Business Loan Protection Disability Contracts. These policies will discharge periodic or lump sum business loan payment obligations on behalf of a disabled business owner. 5.3.2.2 Who needs the coverage? These policies are designed to protect sole proprietors, business partners, and sole owners of incorporated private businesses. The coverage applies where the business has incurred qualifying loans, and the revenue stream of the business is dependent upon the continued good health and active participation of the business owner. 5.3.2.3 Eligible loans. For a loan to qualify for business loan protection coverage, it must meet 3 criteria. Black small square. The loan must be essential to the successful operation of the business. Black small square. Interest paid on the loan must be tax deductible. That is to say, the loan must have been undertaken for the purpose of earning income from business or property. Black small square. The loan must have been issued by a financial institution, bank, trust company, credit union, or loan company. The purpose for which the loan was undertaken must be related to the business operations. For example, black small square mortgages on the premises from which the business operates. Black small square equipment loans. Black small square lines of credit and account overdrafts. 5.3.2. For who qualifies for such coverage? In order to qualify for a business loan protection disability policy, the business must have a history of profitable operation, typically at least 3 years. Insurers usually require that the business meets a minimum standard of net worth. And the business enterprise must be engaged in operations ranked in the higher occupational categories. Normally, the business owner, or the business itself, will be the owner of the policy, will pay all policy premiums, and will be the recipient of any benefits payable. The life insured under the contract will be the business owner, and the definition of disability will be regular occupation. 5.3.2.5 Benefits. Benefits may be payable in one of 2 ways: periodic, monthly, or lump sum. Periodic payments of up to $10,000 are the most common and typically may run for up to 24 months. Lump sum payouts of up to $250,000 are possible, but not to exceed 75% of the loan balance and only after a lengthy elimination period, usually 1 year. Overall, of course, benefit payments are designed to discharge the loan balance, so they could not exceed the amount of the loan. 5.3.2.6 Optional benefits. Other optional benefits may be possible, with waiver of premium being the most common. 5.3.2.7 Exclusions. As with most disability contracts, no benefits are payable if any disability occurs as a consequence of war, normal pregnancy, criminal activity, or self-inflicted wounds. As mentioned earlier, like business loan protection, BOE insurance covers the interest on a business loan. However, claims cannot be made under both types of insurance for the same loan, even if the business has both types of coverage. Only one claim can be filed, and the insured must select the contract it will make the claim under. However, as each contract meets different needs, an insured who purchases both types of insurance will not end up overinsured. 5.3.2.8 Tax treatment of premiums and benefits. Since the loan payments being protected are a capital asset to the business, rather than taxable income, premiums paid on these policies are not tax deductible by the business. Benefits received, the discharge of loan principal and interest, on the other hand, are tax-free. For insurance to address the owner's inability to sell the business. At some point, every business owner must dispose of his business in one way or another, sell it, pass it down to the next generation, or let it die or retire with the business owner. If the business has a value beyond the involvement of the owner, it is in the best interest of the owner and the owner's family to prepare for and pre-plan that eventuality. 5.4.1 Buy-sell agreements. Buy-sell agreements can be used to predetermine the purchase and sale of business assets in the event of the death, disability, critical illness, or retirement of a business owner. Often agreements are drafted covering all eventualities. Buy-sell agreements in the event of death are covered elsewhere in another manual. This manual will deal exclusively with the disability of a business owner. 5.4.1.1 Purpose of an agreement. For the owner/operator of a closely held business, the business is often the owner's primary asset and sole source of income. The greatest concern for the business owner is, should he suddenly become disabled, what will become of the business? If the business cannot be carried on, or sold to a third party, how will the business owner, or the business owner's family, survive financially? On the other hand, without a clear succession plan for the business, employees are concerned for their jobs, should the business owner become disabled. And co-owners, if any, will be concerned about having to support a non-productive disabled co-owner, and the possibility that they might be compelled to work with that co-owner's spouse, children or other family members. A properly structured and funded buy-sell agreement can provide assurances for all parties involved. 5.4.1.2 Parties to the agreement. Often, the most difficult type of buy-sell agreement to arrange is one covering a sole proprietorship, particularly if the business in question has no employees, or at least no key employee. In the event of the permanent disability of the current owner who is there to buy the business. In the case of a partnership, the surviving partners are the obvious market for the business interest of a permanently disabled owner. If the business is incorporated and has more than one shareholder, the shareholders who are not disabled are the most logical, potential purchasers of the business interest. In the case of any type of business entity, a key employee could also be a potential successor owner, and therefore, a potential party to a buy-sell arrangement. Regardless of who the potential buyer might be, it is also important that both the seller and the seller's spouse/common law partner, if any, be parties to the agreement. In most Canadian provinces and territories, the spouse or common law partner of a business owner may have an ownership or equalization claim against the business owner's property in the event of marriage or relationship breakdown. If the spouse/partner is not also bound by the agreement, ownership rights and other legal entanglements could delay or completely derail the sale of the business interest of a disabled owner. 5.4.1.3 Elements of an agreement. The key to an effective buy-sell agreement is certainty. The parties to the agreement must know in advance. Black small square Under what circumstances is the agreement triggered? Black small square Will the current owner be required to sell the business interest? Black small square Who is required to buy the business interest? Black small square When must the purchase and sale take place? Black small square At what price will the purchase and sale take place? Black small square How will funding for the sale be effected? Typically, the provisions of a business buy-sell agreement specify that the agreement is to be effective in the event of the disability, critical illness, death or retirement of a current owner. Disability is defined as the inability of an owner to carry out the main functions of his regular role with the business, regular occupation. The buyout mandated under the agreement will not usually take effect until the business owner has been disabled for a lengthy period of time, 12 months or longer, to ensure that the disabled owner wouldn't be able to recover and resume full participation in the business. The current owner and the owner's estate, heirs or assignees are bound under the agreement to sell the business interest upon the occurrence of a specified event, permanent disability, in this case. Once the agreement is triggered, the owner, the seller, has no choice but to sell his interest upon the conditions set out under the agreement. This affords the other party, i.e., to the agreement, the buyers, the comfort of knowing that they will be able to buy the business. On the other hand, the agreement also compels the buyer to buy the business interest, according to the terms of the agreement, once the triggering event has occurred. This prevents the potential buyer from leveraging his advantage to compel an unfairly low price. It also gives the seller, or the seller's representative, the certainty that a sale will take place at a fair price. Obviously, the time frame for the purchase and sale of the business cannot be open-ended. Under a disability buy-sell, the purchase and sale must take place, at the latest, within 1 year of a current business owner becoming disabled, but typically sooner, as little as 90 days after expiry of the waiting period. It is important to establish the price, or the method of establishing the price, of a business interest in advance. A buy-sell agreement should commit the buyer and the seller to a price that will not be subject to negotiation at the time that the buy-sell is triggered. This is normally effected in one of 3 ways. A fixed price: the parties agree in advance to the price to be paid under the agreement. This price may or may not be indexed annually. This is the least preferable method, in that the value of the business interest will likely change over time, requiring that the buy-sell price will have to be amended regularly or run the risk of being out of date and inappropriate. A price formula: the parties agree in advance upon a formula to be used to value the business interest, a multiple of earnings, for example. This formula is then embedded in the buy-sell agreement. Use of a third-party valuator: the parties agree in advance to employ the services of a professional business valuator to value the business interest when the agreement is triggered. The identity of the valuator is written into the buy-sell agreement, and the valuator's assessment will be binding on all parties. A mandatory purchase and sale at a predetermined price is only of value to the parties involved if the purchaser has the financial capacity to meet his obligations under the agreement, to afford the purchase price. In the absence of guaranteed funding, the agreement to buy the disabled owner's business interest may be nothing more than a hollow promise. The agreement is most often funded in one of 4 ways. Use of personal assets: the buyer has liquid assets, or liquidates other assets, sufficient to cover the purchase price. Unfortunately, few buyers are likely to have sufficient funds on hand to make such a large purchase. A loan: the buyer borrows funds from a financial institution to effect the buyout, possibly using the business itself as collateral. This approach has a number of drawbacks. White small square: there is no guarantee that the buyer will be in a position to obtain the loan. White small square: the loan has to be paid back with interest. White small square: the loan payments will have to be drawn, presumably, from business profits at a time when business revenues are reduced. Black small square: installment payments from the business profits. The buyer purchases the business interest with a series of installment payments drawn from the revenues of the business. This approach has the dual disadvantages of white small square: leaving the seller, or the seller's family, uncertain about whether the installment schedule will be able to be maintained. White small square: the new owner would have the challenge of trying to generate a personal income from the business, while also maintaining the installment schedule. Insurance on the life of the disabled owner: a disability buyout policy on the life of the business owner can provide a guaranteed lump sum benefit to fund the buyout. The policy would be owned by, paid for by, and payable to the prospective buyer, who would, in turn, use the policy proceeds to buy the interests of the disabled business owner. Funded in advance with premium payments, the policy would guarantee that the necessary funds would be available when needed. The policy could be customized to parallel the terms of the buy-sell agreement: amount of benefit, definition of disability, waiting period, etc. In most instances, this option would be the preferable one from the standpoint of both the potential seller and the potential buyer. 5.4.1. For types of agreement. There are 2 basic types of buy-sell agreement. Where 2 partners or co-shareholders of an incorporated business are required to purchase the business interest of the other, the agreement is called a cross-purchase or crisscross agreement. If the agreement is funded by insurance, each party owns, pays for, and is beneficiary of a policy on the life of the others. In the case of a disability buy-sell agreement, the insurance proceeds are used to purchase the interest of the disabled business owner. Where the business entity itself is required to purchase the business interest of a partner or shareholder in the business, the agreement is called an entity purchase or share redemption agreement. This form is often used in the case of a partnership or an incorporated closely held business with two or more shareholders. In the case of a disability buy-sell, any insurance funding is owned by, paid for by and payable to the partnership or corporation. The insurance proceeds are then used to buy out and cancel the business interest of the disabled partner/shareholder. In the case of a cross-purchase agreement, sale of the business interest is a disposition for income tax purposes at the purchase price, resulting in the selling business owner having to report a capital gain or loss for the year of sale. This will be the case regardless of the type of business structure involved. The purchaser will acquire the business interest with an adjusted cost base equal to the purchase price paid. If the business is either a partnership or closely held corporation, and the business acquires the disabled owner's interest, the tax consequences would differ. If a partnership buys out a partner's interest, the transaction is a capital transaction, resulting in a capital gain or loss reported to the seller for the year of sale. If an incorporated company purchases its shares directly from a shareholder, the portion of the proceeds equal to the paid-up capital (PUC) value of the shares is treated as a tax-free capital transaction. Any amount paid for the shares in excess of the PUC value is considered a dividend taxable in the hands of the seller, as this insurance benefit does qualify to pass through the capital dividend account. 5.4.2 Disability Buyout Insurance. As noted, a disability buy-sell agreement may be of little value if it is not accompanied by a disability insurance (DI) policy specifically designed to provide capital to meet the needs of the buyout. Although the insurance is sometimes put into place before the buy-sell agreement is implemented, ideally the two should be designed in tandem so that the features of both waiting period, benefit amount, definition of total disability, structure of payout, etc. can be properly coordinated. 5.4.2.1 Definition of total disability. Since the purpose of the buy-sell agreement and the funding DI policy is to provide capital to buy out a business owner who can no longer function within the business, the most frequently used definition of total disability is regular occupation. In some cases that is extended to own occupation and not working, meaning that the insured owner is not able to carry out his regular duties within the business and is not working at any other occupation within or outside the business. 5.4.2.2 Waiting period. The waiting period on a disability buyout plan is much longer than for other types of disability contracts. Disability buyout plans usually have a waiting period of 12 months, sometimes as long as 18 to 24 months. Likewise, the buy-sell agreement most often calls for the buyout to occur 12 months, or longer, after the onset of total disability. Note that the waiting period in the insurance policy should be based on the period outlined in the agreement, not the other way around. The long waiting period is to give the disabled business owner time to recover and return to active participation in the business, if possible. 5.4.2.3 Benefit and benefit period. Benefit periods on DI policies can run from 2 to 5 years, and sometimes 10, all the way to the life insured's attainment of age 65. But the benefit period for a disability buyout policy is often only 1 day. A lump sum benefit is paid out to fund any buyout at the end of the waiting period. While lump sum payouts are common, some contracts and the corresponding buy-sell agreements provide for part of the benefit, 50%, to be paid in a lump sum, with the balance paid out in equal installments over as many as 60 months, 5 years. Others pay no lump sum, only installment payments. Should the disabled business owner recover during the benefit period, there is no impact on either the buyout or the payout. Once the waiting period has been met, the buyout is triggered and the payment begins, regardless of the subsequent health of the owner. 5.4.2. For coverage amount. Disability buyout policies often provide coverage for as much as $1 million, with some contracts extending the coverage to as much as $2 million. 5.4.2.5 Features of the policy. Disability buyout contracts are conditionally renewable and non-cancelable. The insurance company cannot amend the premium and must renew the contract up to a specified age unless certain conditions are not met. For example, the insured owner is no longer an owner of the business. Policies often have a reducing benefit schedule after the life insured attains age 60, reducing by 20% of the original face amount per annum, in recognition of the pending retirement age for the insured. Most contracts will include a future purchase option, FPO, guaranteeing the right to increase coverage at preset dates, without evidence of good health, to allow the value of the insurance benefit to keep pace with future increases in the value of the business interest. 5.4.2.6 Termination of coverage. Disability buyout policies will provide for termination of the coverage in the event that the life insured is no longer an owner or co-owner of the covered business, or the business itself is no longer operating. Some policies offer a conversion privilege, however, permitting the insured to convert the policy, or a portion of the policy, to personal coverage, without medical evidence of insurability. The insured would, however, have to be able to justify the level of the converted coverage financially. 5.4.2.7 Tax treatment of premiums and benefits. Disability buyout policies are owned by, paid for by, and payable to the prospective buyer of the business. They ensure the life of the current owner or co-owner. Premiums paid are not tax deductible by the policyholder, nor are they reported as a taxable benefit to the covered life insured. Benefits received by the policyholder, in the event of disability of the life insured, are received tax-free. 5.5 Insurance to address the loss of a key employee. Disability insurance is generally employed to protect the income of an individual in the event of a prolonged period of disability. But the business employing that individual is an entity unto itself, and the income of the business may equally need protecting should it be interrupted due to the disability of a key employee. 5.5.1 Key Person Insurance. Key person insurance is a life insurance, critical illness, CI, insurance, or DI policy on the life of a key person, intended to protect the employer in the event of the loss of services of the key person due to death, disability, or critical illness. 5.5.1.1 Who is a key person? There are often one or two employees within an organization whose skills and contributions are so unique, and whose contribution is so important to the success of the business, that they are very difficult to replace, especially in the short term and on a temporary basis. Such a person is referred to as a key employee or key person. Their services could be as a business owner, a key executive, a technical expert, a systems designer, a trainer/motivator of the sales force, or a variety of other roles that contribute materially to the success of the organization. The business cannot protect against any eventuality, but insurance on the life of a key person can be used to protect the business financially in the event of the death or disability of the individual. 5.5.1.2 Purpose of the coverage. Key person disability insurance is designed to provide the employer with cash flow to offset a number of potential losses to the business arising from the key person's absence from work due to disability. The types of situations the funds are typically intended to offset include: Black small square a decline in productivity due to the loss of the key person's services. Black small square a decline in productivity of other employees due to the loss of the key person's support or guidance. Black small square a decline in sales or networking contacts. Black small square the cost of recruiting and training a replacement for the key person, if necessary. One of the main restrictions on who can be considered a key person for insurance purposes relates to the issue of ownership of the business. Various insurers place a maximum limit on ownership, ranging from 10% to 50%, before an individual is disqualified from coverage. 5.5.1.3 Terms of the contract. The definition of disability under a key person policy is some form of regular occupation. The whole point of setting up the coverage is to protect the employer because the business cannot function profitably without the regular services of the key person. The policies are conditionally renewable, provided the life insured continues to be employed full-time with the same employer. 5.5.1. For riders. Most key person policies include provisions for waiver of premium and recurrent disabilities, and many may include a replacement expense benefit rider, which provides for an additional payout to cover the costs associated with hiring a replacement employee, if necessary. 5.5.1.5 Benefits. Key person disability benefits are usually restricted to no more than 100% of the life insured's annual salary, paid monthly, to a maximum of about $15,000 a month. The addition of riders, such as a replacement expense benefit, may increase the standard payout. 5.5.1.6 Waiting and benefit periods. Because the whole point of insuring a key employee is that the employer's business will be adversely impacted without the benefit of his essential services, the waiting period for these policies is usually kept short, in the range of 30 to 90 days. Benefit periods are usually no more than 12 months, because the business cannot carry on indefinitely without the services of the key person. If the life insured is going to be off work for more than a few months, at the longest, the employer will likely have to find a replacement. 5.5.1.7 Tax treatment of premiums and benefits. Key person disability policies are usually owned by, paid for by, and payable to the employer. Premiums paid are not tax-deductible by the policyholder, nor are they reported as a taxable benefit to the covered employee. Benefits received by the employer, in the event of disability of the insured employee, are tax-free. 5.6 Other types of business insurance plans. Although not strictly business insurance, in the sense that they do not necessarily insure the interests of the business or the business owner, there are a number of other types of disability and health insurance arrangements that warrant brief consideration. These plans are sometimes broadly referred to as health spending accounts or healthcare spending accounts. 5.6.1 Health and Welfare Trusts, HWTs. When employers wish to provide health benefits, dental care, vision care, a prescription drug plan, etc., for the benefit of their employees, they typically do so by setting up an insured group plan. An alternative to group insurance is the Health and Welfare Trust, HWT. These are trusteed arrangements funded for the sole purpose of providing the employees with health care benefits. The HWT often offers employees more flexibility in the choice of benefits than can be found under a typical group plan. Specific requirements for an HWT are set out in the Canada Revenue Agency's Income Tax Folio S2, F1, C1, Health and Welfare Trusts, dated July 27, 2015, and modified November 27, 2015. It replaced and cancelled Interpretation Bulletin IT, 85 R2, Health and Welfare Trusts for Employees dated July 31, 1986. 5.6.1.1 Contributions to the Trust. Contributions are usually made by the employer only, on a mandatory basis, and may never revert to the employer. There is no statutory restriction on the amount of annual or cumulative contributions, although the Income Tax Folio S2, F1, C1 specifies that the employer's contributions must not exceed the amount required to provide health and welfare benefits to employees. There is no time limit specified during which the employees are required to utilize the contributions to acquire benefits. 5.6.1.2 Income tax implications. Provided the HWT meets the requirements of Income Tax Folio S2, F1, C1, contributions are tax-deductible by the employer. Employees who are beneficiaries of the trust are not required to report a taxable benefit at any time, not at the time of the employer's contributions to the trust nor at the time of receipt of health benefits paid for by the trust. 5.6.2 Employee Health Trusts, EHTs. Introduced in 2010, Employee Health Trusts, EHTs, are a variation of the HWT. The EHT is specifically provided for under S. 144.1 of the Income Tax Act. HWTs, on the other hand, rely solely on the administrative practices of the Canada Revenue Agency, CRA. Also, the trust that administers an EHT must reside in Canada, a restriction that does not apply to HWTs. As with HWTs, employer contributions to an EHT in order to provide accident and sickness, but not life insurance, benefits for employees are tax-deductible for the employer, but are not treated as a taxable benefit for the employee. Contributions to the trust cannot revert to the employer, and must be used to provide specified benefits for the employee and his family, usually for the payment of premiums on individual or group accident and sickness (ANS) insurance plans. In general, EHTs are used by medium to large employers because of the complexity and cost of administration. 5.6.3 Personal Health Spending Plans, PHSPs. Personal Health Spending Plans, also referred to as Private Health Services Plans, PHSPs, are designed to provide health care benefits for sole proprietors, partners, and their families. Contributions are made to the plan, to a prescribed maximum, and may be used to directly pay for health care services, such as prescription drugs, vision and dental care, and a wide variety of other medical services. Any service or product qualifying for the medical expense tax credit qualifies for these plans. Contributions for business owners and adult members of their families, spouses, for example, are limited to $1,500 per year for sole proprietors. Contributions on behalf of family members under the age of 18 are limited to $750 per year. The contributions and disbursements are handled by an administrator, who will charge a fee for the service. The plans offer tax advantages not otherwise available, and are beneficial to the business owner so long as the tax advantages outweigh the administrative costs of the plan. The only real restriction is the fact that contributions to the plan must be used to purchase qualifying services within 2 years of contribution, or they will be forfeited. Employer contributions that fund purchases of qualifying health care products and services are 100% tax deductible for the employer, up to the maximum stated above, and do not constitute taxable income for employees. 29. Most of these PHSPs include travel insurance coverage and an exceptional expense rider to cover such items as a semi-private hospital room. 5.6 For group disability/critical illness plans. A grouped plan is an arrangement whereby an employer agrees to acquire, fund and hold DI or CI contracts for the benefit of 2 or more. One employee does not constitute a group of its employees, rather than using a group insurance plan offered by an insurance company. Benefits claimed under the policies are paid directly to the disabled employee. The employees who are beneficiaries of a grouped plan must be members of a given class of employees within the organization. They cannot be either selected or chosen at random from within the whole workforce. Each member of the identified group must be offered similar benefits if insurable. However, different grouped plans may be set up for different classes of employees. The group may not be comprised exclusively of shareholders of the employer, or the tax status outlined below will not be afforded the plan. However, shareholders may be members of the group, along with non-shareholder employees, so long as the shareholders are also employees of the company. If the grouped plan is properly structured, the employer can tax deduct premiums in the year in which they are paid. On the other hand, the employees do not have to report these employer-paid premiums as income. However, if the employees claim benefits from the plan, those benefits are taxable in the hands of the employee. 5.7 Taxation of benefits. Table 5.1 provides a brief summary of the income tax implications to the employer and employee arising from the payment of premiums and receipt of benefits under business use DI policies. It is important to note that, if the business in receipt of disability insurance policy benefits is a private corporation, there is no credit to the corporation's capital dividend account, as there is with life insurance proceeds. Funds distributed to shareholders by way of a dividend would be treated as a taxable dividend in their hands. 5.8 Integrating business and personal disability coverage. DI coverage can arise from a large variety of potential sources. Black Small Square Canada Pension Plan, CPP. 31 Black Small Square Government Employment Insurance, EI. Black Small Square Provincial Workers' Compensation Plans. Black Small Square Group or Group Plans provided by an employer. Black Small Square Individual Accident and Sickness, ANS, policies. Black Small Square Disability Benefits attached to life insurance contracts. Black Small Square BOE plans. Black Small Square Business Loan Protection Plans. Black Small Square Disability Buyout Coverage. Black Small Square Key Person coverage. The challenge for insurance advisors is to coordinate all these plans to ensure that, Black Small Square, there are no gaps in coverage protecting the client or the client's business. Black Small Square, there is no needless and expensive duplication in coverage. 5.8.1 Owner's need for personal insurance. The most obvious situation where gaps/overlaps might occur is when the client is the owner/operator of a business, particularly one with employees. A disability program focused on protecting the employees might indirectly strengthen the position of the business through increased loyalty and productivity, but would do little or nothing to cover business expenses, generate profits, or protect the net income of the business owner. A sole proprietor with a personal income replacement disability policy might find his income adequately provided for in the event of a prolonged disability, but if his business and employees are not also protected, the proprietor might not have a source of income to return to when he recovers. Coverage levels and waiting and benefit periods need to be coordinated to avoid any gaps or overlaps in coverage of benefits if other disability payments are available, except those coming from a privately owned income replacement plan. In any event, most plans will have an all-source maximum built into their benefit schedule, capping benefits from all plans at 85% of pre-disability income. If the business owner is receiving group or grouped benefits, in addition to benefits from government plans and a private disability income replacement policy, benefits could be prorated to ensure that the total payout does not exceed the 85% level. Chapter 6, Client Profile. Competency components. Black Small Square assess the client's needs and situation. Black Small Square implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Black Small Square determine the client's situation. Black Small Square assess the appropriateness of the client's existing coverage in regards to his or her situation. Black Small Square articulate the client's needs based on the risks that could affect his or her financial situation. Black Small Square propose a recommendation adapted to the client's needs and situation. Accident and Sickness Insurance. Chapter 6, Client Profile. 130.